morning for those of you in the Australia, New Zealand, Asia Pacific region. Good evening, late in the evening for those of you in Europe, and late afternoon, early evening for those of you in North America, depending on what side of the continent you are on. Welcome to the 8Cap Trade Zone webinar. This is the third in a series of 4. My name is David Floyd. I've been the guest analyst this month here at 8Cap. And I trust that you've been enjoying the weekly preview videos as well as the live broadcast here. And for those of you that signed up for the access to my daily market forecast, hopefully you've been finding that useful as well. Given that we're the third webinar in here and you're pretty familiar with what I do and how I broadcast it, or not broadcast it, approach the market, what I would really like to do today is really have it be more of a Q&A session. I'm happy to talk about a few things, but again, as I said on the first webinar, my intention is not to sit here and just talk at you. I'd like to have a dialogue, and even though you might be texting it through the GoToWebinar platform, at least we're having some sort of a dialogue, and I know that people are actually paying attention and engaged and wanting to learn about this. If not, it's just me talking, and it just doesn't create a really solid dynamic, quite frankly. So let me go ahead and get set up. Let me get a couple of windows set up here so I can see questions and whatnot. So give me 2 seconds here, folks. So we got the chat set up. Oops. There it is. All right, so please type in your questions. If not, I'm just going to run through a couple of charts here and then, basically leave you with kind of what I'm seeing in the markets and how I'm looking to play that. Maybe not in the overnight session, although if we hit a couple of levels, I might be engaged. On the S&Ps, there are a couple FX trades that I'm looking at, but largely, when I trade the S&Ps, I'm usually doing it during the New York session. But for some more longer term setups where I'm looking for key levels, I'm happy to execute in the overnight, but I'm usually not doing the intraday or shorter term trading in the S&Ps in the non-New York, what they call the pit session. So what I want to focus on first is the S&Ps, and I do that for a couple of reasons. One, it's the market I trade, very actively. Trade that a lot during the day. I do some occasional swing trades in it. I mainly trade FX more on a swing trading basis. But the reason I focus on the S&Ps is that it's usually a pretty good barometer for it driving other related markets. 10-year notes, although you could argue 10-year notes sometimes sway S&Ps and vice versa. But equity markets have a big impact on FX, as do interest rates, as do related commodity markets. But by looking at the S&Ps, it's a good overall gauge of what the market is looking at in terms of risk on, risk off, how they're viewing macro events, how they're viewing monetary, political events. It's a good gauge of what's going on, and that helps you to kind of set up and frame trades in related markets like FX and 10-year notes. So I don't think there's any real mystery that we have been very volatile and very not choppy, but very volatile in the S&Ps, but there have been some tremendous trading opportunities. And the chart that you're looking at right here is just simply a 30-minute chart. I don't have the Aspen support and resistance levels drawn in on this chart. I have the ones that I'm interested in now drawn in here manually that are color-coded according to, these ones are they're just there for dragging and dropping into place. But these are the levels that we want to be looking at. As you can see, this 44.43 level has been pretty dang pivotal. During yesterday's session, again, as I always tell clients, a support level is a support level until proven otherwise. So we're not trying to, as prices move lower here, and I can spread out my chart here a little bit. As prices are moving lower here, I'm not sitting here thinking, oh, I want to get short a break of that support level. It's not how I do that. I'm expecting that support level to hold. It got taken out. It was previously resistance. Prices rallied above. We come back and retest it. Yes, could it break below? Of course it could. But until proven otherwise, I'm assuming it's a support level. Got a nice rally here, retested it, moved up, back down. Then we had the big move back above it this morning on the heels of the Fed minutes, and we're quasi bullish at this point in time. The real challenge I'm having with the market right now, at least in terms of being bullish, meaning comfortable sitting with the position and holding it, is that we're stuck in this key range right here between 44.72 and 44.61. So basically a 12-point range. And as you can see, the price action during the New York session was pretty well contained in it. Bullish bar up, bearish bar down, but we are stuck in this range. I'm inclined, given that the longer term level, support level here is at 44.43, I'm overall leaning bullish the S&Ps. But it's really hard for me to fully embrace it until we can not close. I don't need a daily bar close above here, but I need to see some intraday price action holding above 44.70. And then if that happens, we're off to our next destination, which is 45.05, which for those of you that have been paying attention for the last couple of weeks has been an incredibly pivotal level. If we went back in time and drew that line onto this particular chart, we'd see that prices have come up to it many times and failed. So anything above 44.70, I want to be long, expecting a move into 45.05. So that's a good 35 point move. That adds up real quick at $50 a point per contract. We get above 45.05, we're going up to the next level, 46.26 or 46.27 actually. So again, I'm bullish until proven otherwise, but I'm not doing anything in here. I'm not sitting here going, I'm going to get long. I need to see price action demonstrate that it wants to move higher, hold above 44.70, 44.72, then I'm inclined to get long. We break back down below 44.43, then I'm bearish, because then support then becomes resistance. So that's how I'm looking at the S&Ps. Questions on that? How many in here trade the S&Ps, or am I, talking about a market that is of no interest to everybody here? Okay. I'm not getting any dialogue from anybody in here, so I don't know if what I'm discussing here is relevant, if it's helpful for you. I mean, if you're trading the S&Ps, this is very helpful information. If you're not trading S&Ps, I don't know what, this probably may not be relevant for you, at least from a trading perspective, but it might be from an analytical perspective. So finally got a couple of people responding here. Okay, Jonathan says he trades S&Ps. Okay, wonderful. So this is relevant to you. James says he trades FX. We're going to get to FX in a moment. David brings up something that I think is interesting, and I'm going to refute it or offer a counterpoint. He says, I trade the S&Ps, but Ukraine's keeping me flat. I can only assume, David, that you're keeping flat because you're more of a swing and or position trader. And if that's the case, sure, I get that. You don't want to get what they call a tape bomb, no pun intended, since the Ukrainian situation is obviously, war related. But that's what they call it in the industry, a tape bomb. A news item hits the tape and boom, your position is in your favor or out of your favor very quickly. So I can only assume, David, that the Ukrainian news is keeping you on the sidelines, as you say, because you're more of a swing trader and or position trader, and I can completely respect that. From an intraday perspective, I don't really give a crap. Headlines are going to come, headlines are going to go, but I'm trading momentum and I'm trading off of price levels. And if I get caught once in a while, that happens, but none of us can predict when a headline is going to hit the market. And even more so, even if we know a headline's coming in the form of an economic event, we have no idea how the market will react. Even if the numbers are really, really good, the market could sell off. It's just, for me as a trader, I trade price levels, and once in a while I'm going to get my wings clipped, but by and large, trading momentum in and around price levels works just fine. I don't have to factor too much in what's coming on the economic calendar, what's happening on the geopolitical front, although that does drive price action overall, but it's not driving my independent trading decisions. So hopefully that's clear there. Okay, Ami says that he trades the Dow Jones 30. Okay, wonderful. Same logic prevails here, and usually if these levels are reacting in the S&Ps, you're going to see the Dow get dragged along. Most of our markets are pretty well correlated nowadays. You do get some deviations from time to time. So that's how I see the S&Ps. So David, from your perspective, if Ukraine, let's say Ukraine wasn't even on the table right now, we were dealing with a fairly calm geopolitical situation, a level like 44, 47 is kind of something you would want to lean on. It's a longer term level. The levels I have here are color coded, and they're based on the significance of the level, which is all based on time. I have 4 sets of support and resistance levels or channels that I have calculated on my charts, something that I have created over about 1.5 years, 2 years ago. Red is a pretty significant level. They go from green, orange, red, and purple. And that's in ascending order of importance. All the levels are important, of course, but obviously if you're dealing with levels that are dealing with a lot more price data, meaning a longer look back period, that's going to be a more significant level. Red, pretty dang significant. And as you can see, the market has respected that. Market recognizes that that level is significant. And the reason they do is as follows. And for those of you that are new or maybe haven't been on the previous webcasts, these support and resistance levels are not subjectively drawn by me. I'm not coming in and going, oh, we've held this, I'm going to draw a line in there. That's how you do classic technical analysis. And there's nothing wrong with it, but there is a little bit something wrong with it. That's one's opinion, one's view of where a support level should be drawn into. When I came up with the idea for the Aspen support and resistance levels, my logic was really simple. I want to draw in levels on my chart that are widely recognized by the market by virtue of them being actively traded price points. Therefore, if I can isolate the levels where a lot of activity has taken place, in factoring in a few other factors as well, I'm relatively confident that when prices get to those levels, there'll be a reaction. Because that's the problem with both fundamental and classical technical analysis. You could do great work, be very accomplished as a technician, but as I've said many times, and I say to clients and potential clients all the time, unless somebody else agrees with the way you're drawing your technical analysis on your charts, the market's not really going to react to it. It might be very diligent, very well thought out analysis, but unless the market collectively views the levels that you've identified as important, what does it really matter? Because it takes many traders, many investors at a particular price point to move the market up or down. Unless you've got people interested, and a large contingent of people interested, whether they be institutions or a whole slew of retail traders, unless you have a lot of people interested in a particular level, prices are just going to kind of, go about their business. The market's not going to recognize it. These levels, on the other hand, they're not foolproof, of course, but by and large, these levels will be respected by the market. You can see that in this instance here. And I've shown many instances on the previous webinars. You can go back and look at them. These levels are going to alert you to when you want to be paying attention. So go back to you, David. Again, if Ukraine wasn't an issue, if prices started to pull back and retest that, I'd be a buyer there. And you know where my stop loss is? A few ticks below. Once prices go below that, I don't need to hang around too long, because once prices go below that, I'm out. Now, you could say, well, geez, you got short here. or you got stopped out and then prices rallied. Okay, well, you get back in. No trade is ever going to be perfect. What I want to do, and what all traders want to do, is want to take a small loss for a lot of upside gain. And again, trading, buying the pullback here from an intraday perspective worked very well. Very, 1 or 2, 1 to 3 or maybe 5 point stop loss, and then you get a 20-point rally in the S&Ps at $50 a point per contract. That's $1,000 trade right there, or $500, $1,000 trade right there. And you're risking, $250. I'll take that trade all day long. So that's where we are. So to answer everybody's question that might be thinking of it, I'm focusing on the S&Ps right here. Can you have these levels drawn on any chart you want? Yes, you can. If you use TradingView, I happen to use MotiveWave, but if you're a TradingView user, these levels can be automatically drawn on your chart. They end up looking something like this. I know this might look a little overwhelming, so bear with me. But these are the Aspen Trading support and resistance levels. So if you're trading the FTSE, as Robert is talking about, great. These levels will be drawn on your chart. Whoever trades Dow Jones 30, they'll be drawn on your chart. What I want to point out on this chart is that each color forms a band. There's a red band, a green band, purple band, and an orange band. I'm not going to go into too much of the dynamics of how they work because that's not what we're here to do. Although if you want to ask questions about them, happy to address it. But you don't have to manually draw these on your chart. They can automatically appear for whatever symbol you want. So that being said, let's take a look at the Kiwi dollar. Kiwi dollar is of interest to me, big time of interest to me on the bullish side. So in this case, we've got the green band, which again is the lowest of the bands in terms of significance. We've got the lower green and the upper green. And we've got a couple of other levels that are kind of coinciding with that, the orange and the red. The way I look at that is as follows. Right now, 66.90, which is basically the upper green band. Yeah, 66.90. That's right now resistance. Until prices break below there, maybe I could go short here, but I'm not going to go long just yet. But if prices get above 66.90, and certainly if they get above the lower red band here at 67.02, the logic of using these bands is as follows. Prices move above the green band in its entirety, that's very bullish. They move inside the lower of the red band, that's very bullish. At minimum, we should go from 67.04 all the way up to 68.73. Now again, maybe that takes a week, 2 weeks, maybe it takes a month. But that's the general logic. In fact, the general logic would be that we'd go all the way to the other side of the red band. But again, that's getting way ahead of ourselves. I'm not looking that far out. I'm looking to make a trade. I'm not looking to make a grand forecast because that's one, not my wheelhouse, and number two, not something I focus on. I like to focus on more intraday trades and swing trades for FX and say like the 10-year notes. But the S&Ps, I like to be a little bit more short-term oriented. So that's my number one thing right here on the Kiwi dollar, or in terms of the FX market. I also like CAD yen, although it didn't get off to as good of a start as I'd hoped. But again, similar logic. We're trying to get above the upper purple band, which again is the most significant. And we got above that a couple times this year. Got above it, rallied, came back below, went back above it, couldn't really get any traction. Now we're trying it again. So 90.95, 90.97, right in there. We get above 90.90, yeah. We get above 90.97, which we did earlier today. I want to be long, and I am long, but it's just not catching momentum yet, but that's okay. Trades don't always work out immediately. But boy, if we could start getting traction above 91.20 and certainly above 91.47, we got a lot of room to run. I think at bare minimum, then we go back and retest this high back in from October, right at 93.05. So those are the two FX setups that are on my screen right now, all based completely on the support and resistance levels that you see drawn on the chart here. Questions? Happy to address them. Happy to have a look at some of the things that you might be looking at, because again, I can pull up any symbol. I don't have access to the FTSE, so don't ask me to pull that up. But most of the domestic symbols I can pull up. But that's the way I approach the market. all support and resistance levels, and of course you're factoring in what the market's doing at that given point in time as well. Robert's got a question on how do I determine momentum? Well, basically momentum is, you can look at it many different ways. It's what I would call speed of the tape. But let me go back and ask you a clarifying question there, Robert. Momentum on an intraday basis or on a swing trading basis? Because I'm less interested on a swing trading basis. I'm just looking at levels and what the overall temperature of the market is. I'm more interested in momentum on an intraday basis. So I want to make sure I'm answering your question in the right context of how you trade. Intraday, okay, perfect. So that's what I call the speed of the tape. So we go back to the S&Ps. In fact, let's go back to the S&Ps. And I'm going to go back to this chart right here. This is where I'm living right now. So speed of the tape is as follows. We're trying to get above 44.70, and we're currently sitting on support right now. Right now the speed of the tape, now granted it's in the overnight session, so the speed of the tape is slower to begin with. But again, if I'm framing this as a key level, 44.58, the lower band here, I want to see prices react to that fairly briskly. They're not. They've just kind of moved sideways for the last 90 minutes. These are 30-minute bars. So we're just kind of farting along here. So I'll discount that because we're in the overnight session. But if we were in the New York session and we didn't get a meaningful bounce from that, that's a red flag for me. That's telling me that the buyers aren't showing up when you expect them to, i.e. the speed of the tape. When we couldn't get above this into the close today, despite the big move higher, but we couldn't get above that, again, speed of the tape. Couldn't get above it, and then they tanked them, and not tanked them, but they reversed them into the close. So that's what I mean by speed of the tape or momentum. What are prices doing at the levels that you're looking to be long or short at? Is the market reacting to them? Is the market not reacting in the way you thought they would? That's how you factor in whether or not the level is significant. It's still significant, but is it significant in the way you thought? Because I'm just going to say hypothetically here, if I was in the New York session right now and prices had this very tepid reaction off this support level, I'd be saying, I need to consider possibly getting short a break of this level. Prices don't seem to want to rebound. And if I see other things going, south, let's say, maybe the NASDAQ's moving lower, or interest rates are moving higher, or I don't know, maybe cryptocurrencies are moving lower, I'm getting a risk off tone in the market, then I'm going to start saying, maybe this support level, maybe the buyers have just kind of, spent their energy for the time being. So that's how I would define it. Hopefully that's helpful, Robert. I got a question here from Jonathan. How do you set your 4 levels? How do you mean? I think I know what you're driving at there, Jonathan, but I need a little clarification. Oh, it's all based on time frames. The length of the time frame that I'm using to calculate those bands. I'm not going to share with you what those time frames are because they do fluctuate based on the volatility of the market, but they're basically based on preset slices of time. So as I said, green is going to be more of the shorter term period. So you're using a fairly small period of time to calculate those 2 bands, the upper and the lower. When you get out to the purple band, which is the most significant, you're looking at a much higher time frame. So all you need to know in terms of using them is that purple is the most significant. Obviously, prices are going to interact with the purple levels far less frequently than they will with the green ones or the orange ones, which is the second time frame up. So again, it's not to say that any of them are less significant. You're just not going to interact with the purple ones very often, but you're going to interact with the green ones probably week in, week out. You'll see them fairly often. You'll in a course of a month, if you're trading something like the S&Ps, you're going to be interacting with the green the green bands for sure. You're certainly going to be interacting with the orange bands. So part of that is proprietary in terms of what I'm using to calculate that, or in terms of how I'm calculating it. All I can tell you is that if you look at the charts once they're on there and you use them fairly regularly, you'll find that the market is very responsive to these levels. If you bring in your own trading prowess and read the market, you'll find that you're going to get a nice advantage. You're going to have an edge by using these levels. That's all I can say. Well, Dean, if you're able to type in that you can't type your question, I guess I'm a little confused. If you're able to type that in, you should be able to type in your question. And one of the things I do each morning, I do a morning commentary that I send out to clients. I basically review a couple of scenarios in the S&Ps. I review the key levels I'll be looking at, and I'll review some scenarios, meaning we get above here, that's the bull zone. I want to be a buyer above here, I want to be a seller into here. And then I'll go through a few other related markets in FX, 10-year notes, volatility index. I watch that very closely because I'm trading the S&Ps. So, if you're not sure how to use the bands or how to get up to speed using them, having that in conjunction with using the support and resistance levels is kind of like a daily guide in how to use them in real time. So unless we have any more questions, I'll just wait to see if Dean can get his question in here. Looks like that's pretty much it then. Last minute question, last call on questions. If you don't have any questions, well, we will end the webinar there, but I've given you plenty to chew on in terms of 2 FX setups and how you should frame the S&Ps, whether it be in the overnight session or certainly during the New York session. Here we go. I don't have any answer on that, Robert. The question was, with all these cryptocurrencies, how do you identify scams? Well, one, I don't do anything in cryptocurrencies. I do provide coverage on Bitcoin and Ethereum to clients, but purely from a technical level. But it's not a market that I trade and not something I could really, unfortunately, answer. Call me old school. I'm sticking with the big, thick, and liquid markets, and haven't really bought into the whole crypto thing. And maybe that's been an opportunity cost for me. But I stick with what I know. I've been doing this for 23, 24 years. We've been trading the S&Ps a long time, been trading currencies a long time. I stick with what I know, and I think that's what all traders need to do. The more you dance around, the more you try to reach into different areas, the less successful you will be. You need to look no further than any other profession. Firefighters fight fires, surgeons do surgery, lawyers practice law, traders trade. That doesn't mean they trade everything. I've been in this industry a long time. I know a lot of folks on the institutional side, I know a lot of people on the retail side that are successful on both sides. None of them, and I repeat, none of them trade more than a handful of markets. In fact, most of them only trade 1 or 2 markets exclusively, and then they keep an eye on some peripheral markets. I look at, realistically, I trade the S&Ps and a handful of FX pairs and 10-year notes, primarily focused on the S&Ps. If you start trying to dabble in different markets and different setups, I don't know what to tell you. I've been at this too long. I've never seen anybody do it successfully, and I've never seen anybody at the big institutions do it. And I've got a couple clients that are at Citadel in London. My clients over there, as well as everybody else at Citadel who are on the trading desk, they have their markets that they trade. They don't dance around. If you're a dollar yen trader and a euro dollar trader, that's all you trade. You're not one day then saying, you know what, I'm going to go trade Tesla today. Nope. You can't. You stick with what you know. Having that intimacy with the market that you trade offers a tremendous edge, tremendous. So yeah, sometimes you're sitting there staring at your screens and nothing's happening. screw what everybody else is talking about, because you know what? Nobody else is really making any money. It's all a bunch of blah, 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 blah on social media. What happened to all the meme traders? Gone, because that's not a viable strategy. They were in the right place at the right time, and most of them never even made any money from it. The people who succeed in the business focus on a few things, do the same approach time and time again, rinse and repeat, or wash, rinse, repeat, wash, rinse, repeat. That's how you succeed in the long run. So I'll leave you with that, and then I'll get off my moral high horse, so to speak. So folks, I really do appreciate it. If you're interested in the levels, you can get them through my website, aspentrading.com. They're available on TradingView and MotiveWave, depending on what platform you want. I happen to use MotiveWave. That's my platform of choice. But let's face it, TradingView is a very popular platform, and we've got hundreds, actually, we're probably close to 1,000 users now on TradingView, because that is a very popular platform. So you can get them through the website. If you're interested on my thoughts before the market to kind of guide you in using these levels, that's available on my website as well. So it's been a pleasure. I do appreciate the interaction. That's what gets me juiced. I could talk about the markets a lot. I love what I do. It's not a job. It's been my passion since I got out of college. So when you guys ask questions, that allows me to show and demonstrate my passion and also my knowledge. I've been doing this for a very long time. Nobody knows everything in the markets, but I have a pretty good sense of how they work and how you need to approach them to be consistent over time. And that's all I can really leave you with. Ultimately, at the end of the day, the traders that don't make it they don't make it because they're their own worst enemies. They don't follow a plan. They don't stick with the plan. There's no consistency. They're here today, over there tomorrow, and meanwhile, I'm still sitting here trading S&Ps and watching my trading account grow week in, month out, year out. I have bad days, of course. Of course I have. Last Friday, I had a crappy day. Most of it was self-inflicted, which is usually how traders end up doing it. It's not because they're not knowledgeable on that particular day. They forgot and they broke their rules. I'm a human being. I make mistakes. But I came back on Monday and I'm like, don't make stupid mistakes like you did on Friday, Dave, and you'll be just fine. And this has been a great week for me thus far. And we got 2 more days. So I'm really looking forward to it. So wherever you are in the world, thank you so much. Hopefully I can talk to you again, whether it be on next week's webinar, which will be the last in our series, or maybe you'll decide to come over to Aspen Trading, become a client, and maybe we'll have some further chats then. Have a great evening, great morning, wherever you're at. Take care.